We're going to have a short screencast now on an overview of investments. So first thing we need to think about when we invest is diversification. Right? Diversification basically means don't put all of your eggs, don't put all of your investment money in one specific item or one specific investment. Now that might mean purchasing different types of investments in or different categories or different companies or industries in each different category. Mutual funds offer a way to diversify, such as buying, for example, what we call a balanced fund, which invests in a specific, that mutual fund invests in a specific allocation, like 40% bonds, for example, and 60% common stock. So it's some kind of a balance of investments. Diversification helps us to reduce risk. Risk basically is defined as a variation in rates of return. Right? An example of diversification would be if your company matches your contributions on a 401k and your company's contribution, its match is in terms of your company stock, then you would not want to invest in that company stock yourself. You wouldn't want to be putting all of your money in that one specific company investment. Right? Some people buy a mixture of common stock, bonds, commodities, real estate, money market instruments, etc. as ways of diversification for themselves. First type of investment is capital stock. Capital stock would include common stock and preferred stock. All for-profit companies have to have common stock. Now we're going to be really talking here about publicly traded companies, right? Common stock, all shares of common stock have the right to vote for management of the company. They have the right to share in any dividends declared. They also have the right, if the company is liquidates, that they have share in liquidation. Now that their share of liquidation is only after all of preference items like employee wages and taxes, for example, have been paid off. All bondholders have been paid off. All preferred stockholders have been paid off, and there's still money left over, then it would go to common stockholders. Some companies have multiple classes of common stock. So for example, Class A, Class B common stock. Companies that have different classes of common stock, usually what the main difference is in terms of the number of votes per share. Berkshire Hathaway, United Parcel Service, and Under Armour are some examples of companies that have multiple classes of common stock. Preferred stock is usually held by or usually issued by financial institutions, and it's a way for the financial institution to maintain specific required capitalization ratios, which basically means is how much money they have of stockholder money versus how much money they have of debtor money. Preferred stock generally is not voting. Preferred stock is paid generally a regular dividend, like it might be paid a $5 a year dividend, and that dividend would be paid off before any common dividend would be paid off that specific year. So it has a preference in terms of dividends, and it also has a preference in terms of the company's liquidated. It gets paid off its full par value before any common stock would be paid off. Right? Some common terms that we talk about when we talk about common stock, and these are not objective terms. They are more subject a little bit to interpretation. They're more general types of terms. Income stock. Income stocks pay a regular dividend. Blue chip stocks are stocks of very well respected long-term companies that have been around for a long time, like General Electric, for example, or General Motors. A growth stock is more of a younger company, a company that generally pays no dividends, and usually stockholders, people who buy the stock, buy it for future capital growth, which basically is the difference between what they pay for the stock and what they expect to sell it for, or what the market value is going to be worth in the future. We also have what we call penny stocks or pink sheet stocks, and they're basically stocks that are very, very low market price per share, like less than $1 or less than $5 per share. Sometimes we talk about, especially when we talk about mutual funds, for example, mutual funds that invest in large cap stocks, mid cap stocks, or small cap stocks. Caps basically means capitalization. So a large cap stock would be a company that has a large total market value of its shares outstanding. A mid-cap stock would be something that is a little bit smaller total market capitalization, and a small cap stock would be a stock that basically has a fairly small total market capitalization. Again, market capitalization being the number of shares outstanding times the market value per share. Objective when we're dealing with common stock is to buy the shares at a low price and to sell those shares at a high price. Usually when we deal with common stock, we buy in terms of round lots. Round lots basically are a number of lots of 100 shares. So if you have 2 round lots, you have 200 shares of stock. Buying on margin is a fairly risky way to invest in common stocks, but allows you basically to borrow some broker money, and usually that's limited to 50% of the total investment. So for example, you could buy $1,000 worth of common stock using $500 of your money and $500 of money you borrow from your broker. Right? Usually the expectation, the hope is that the stock will increase in price, so you can basically double what you would make in terms of growth on the stock instead of investing $500 if you invest in $1,000. But keep in mind, you have to pay back interest on that money, and if the stock goes down in value, it basically increases the amount of money that you actually lose. Another risky type of way of dealing with stocks is selling short. Selling stock is basically selling stocks that you borrow from somebody that you have to repay in the future. The expectation here is that you're going to sell it today at a high price and hopefully be able to buy it back in the future at a lower price, and when the market goes down, so you can repay that loan at a lower price. Bonds. Now, some common terms we talk about bonds are term bonds versus serial bonds. Term bonds basically pay all the principal at maturity and pay regular payments of interest. Serial bonds pay a combination, pay regular payments of principal and interest. They might pay interest every 6 months and principal once a year, but they make both regular payments of principal and interest. We have corporate bonds. We also have federal government bonds. We have local government bonds, like bonds of the city of Manchester, for example. Bond prices would be affected by things like interest rates. If market rates basically go down, bond prices go up, and also by bond ratings. Companies generally, in order to sell bonds, they have to have the bond rated by one of the bond rating agencies like Fitch, and the value of the bond would go up based on a higher bond rating or go down based on a lower bond rating. Note that most bond investments are not highly liquid, not regularly traded in the market like stock investments are. Bonds might also be considered to be secured or unsecured, basically meaning there's collateral behind those bonds or no collateral behind those. Some of that collateral might be in terms of real estate, and we call those mortgage bonds. Bonds are generally long-term in nature. In terms of liquidation, bonds have preference in terms of payments if the company goes bankrupt over stockholders, but again, those are only after preference items like employee wages, taxes, and things like that, expenses of liquidation, are paid off first. Generally, bondholders have no vote in management of the company. Interest paid on the bond is actually a tax-deductible business expense of the bond issuer. And there's also what we call a zero coupon bond. A zero coupon bond basically means the bond pays no interest, and your interest that you actually earn is the difference between what you pay for the bond and what the bond is going to pay once it matures. Right? Mutual funds. A lot of people invest in mutual funds. Mutual funds are also called investment companies. The mutual fund itself, that investment company, pays no separate income tax as long as it passes virtually all of its income, whether it be capital gains that are actually realized, dividend income, interest income, as long as it passes those off to its shareholders. Right? Shareholders own shares in a collection of investments of the mutual fund. There are many different types of specialty mutual funds, like for example, there are mid-cap and small-cap mutual funds, there are growth index mutual funds, there are mutual funds that mimic the S&P 500, etc. Most mutual funds are valued at what we call net asset value. Net asset value is the difference between the market value of the assets that the mutual fund has minus the liabilities of the mutual fund divided by the number of shares outstanding. So that net asset value per share is determined on a daily basis, right? Management company like Fidelity, for example, sells a variety of mutual funds. Money market instruments are another type of investment. Those are short-term investments. They mature in 1 year or less. Would include things like a negotiable certificate of deposit. That's like a certificate of deposit that you or I have, but you and I, we can't actually sell the certificates of deposit amongst ourselves, but companies will actually be able to buy and sell certificates of deposits if they are negotiable. Banker's acceptance is a short-term IOU that's involved in a import-export transaction, and basically you help to fund the money up front for that short-term import-export transaction. Once the transaction is finally completed, you'll be paid off by the bank, right? Commercial paper. Commercial paper is a short-term IOU, basically 9 months or less. And it's sold by a highly reputable company. So if a highly reputable company like General Electric needs money for short-term purposes, it might go out and borrow that money directly from investors instead of going to a bank. Right? Treasury bills are short-term IOUs of the federal government. Income from stocks and bonds. Bonds pay interest income. Stocks pay dividend income to the holders, right? Note that there are some stocks that never pay dividends. So, for example, Berkshire Hathaway has been around for a very, very long time, since the early 60s, but they've never paid a dividend. Another type of income from an investment is a capital gain. A capital gain is the difference between what you actually paid for the item, the investment, and what you actually sell it for, or the market value. Now, that gives rise to the concept of realized versus unrealized capital gain. A realized capital gain basically means is that you've actually sold that investment and actually realized the income from that investment, versus an unrealized gain basically is a paper gain that you haven't actually sold the investment. Exchange traded funds are similar to a mutual fund, but they're not managed by an investment company. They often track a specific benchmark, such as the Dow Jones Industrial Average, the Standard & Poor's 500, the Russell 1000, or the Russell 2000, or the Wilshire 5000. Now note that the Dow Jones Industrial Average is a very, very small average. It's 30 of the largest companies in the United States, where you get bigger when you talk about the S&P 500, 500 different publicly traded companies, the Russell 1000, 1000 different companies, the Russell 2000, 2000 different companies, or the Wilshire 5000, which is basically almost all of the publicly traded companies in the United States. Shares are directly bought and sold of exchange-traded funds right on the market itself. All right. Real estate investment trusts are commonly abbreviated as REIT. It's a way for somebody to invest in real estate without putting a whole lot of money into that real estate investment. All right. So you're basically buying into something similar to a mutual fund, so you have shares in this mutual fund, that real estate investment trust, and the assets that are owned by that real estate investment trust are real property, which basically is land and buildings. It can help you make a more diversified portfolio. So you might want to have some common stock or some mutual funds and common stock, some money invested in real estate investment trust, some short-term investments, and maybe some bonds as well. Some advantages of a real estate investment trust are that you have professional management. You have broader ownership, because it's basically a whole lot. Instead of being able to, if maybe you wanted to invest $100,000 in real estate, the real estate investment trust would hold a whole lot of different properties that would make up your share of your $100,000 worth of your share of the total value of the real estate investment trust, right? And you can also have a smaller investment than direct ownership as well. Some other investments that you might want, companies might have. Commodities. Commodities would be, for example, gold or silver, some precious metals, or things like corn, cotton, etc. Those are commodities. Cryptocurrencies. Cryptocurrencies are one of the newer fads in terms of investments. They're digital currencies. They're not backed by any government, so they're more risky. Would include things like, for example, Bitcoin. Annuities. Annuities basically means that you're purchasing a series of payments. It's usually making that purchase from an insurance company, and it's often part of a retirement investment. Options. Some people want to invest in a fairly risky type of investment known as an option. The option can be the right to buy, which is called a call option, or the right to sell, which is called a put option, a specific security. Note when we talk about investments that investments are basically a mirror image, for one person has an investment and another company has either common stock outstanding or a bonds payable. All right, so keep that part in mind. Hopefully this was helpful to everybody, and we've used pretty much the whole 15 minutes allotted for this video. Thanks.